A liquidity sweep is simply a stop run. It's a fake move in the opposite direction of the market designed purely to take out stop loss orders. And you will see this in every single market, in every single session, because the highest probability trades always occur after a liquidity sweep. So what actually is a sweep? So can you see this bit of price action right here? So we've got this point here, which is essentially end of Asia, beginning of London's low. Price shoots off massively. Now when it shoots off massively, lots of people are going to start putting their stop loss orders at this low here because they're going to think it's very nice and safe because it's a major sessions low. And then can you see, this is really important here, can you see how price consolidates or accumulates for a bit? You might hear ICT say accumulate. And then look at this point here, right? Where does price go here? It drops massively, but it doesn't drop to any random point. It drops all the way down just below this low here where there's lots of liquidity, instantly shoots off in the opposite direction, gives smart money traders their entry, and then goes in the opposite direction, taking out liquidity. And you will see this over and over and over again in every single market. And it's insane how high probability this setup is. And the reason why it's so high probability is because liquidity is taken out at this low here, right? So this fake move here, right here, is a stop run. It takes out stop loss orders. So any entry after a stop run, after stops have been raided, is super high probability. Okay, so how do we actually make money with liquidity sweeps? What do we actually look for? So if we just explain this in more detail, this right here is the fake move, right? This is a fake move which causes our liquidity sweep. So this blue line here, this dark blue line, this is where the old low is, right? So this is Asia and London's low. Lots of liquidity at this major low here because price shot off. Lots of people think that this low is nice and safe. Price at this point here, so this is Dow, right? So this is indices. So at 9:30 a.m. open, our fake move starts, right? So you'll always find this with indices. At 9:30 a.m., there will always be a fake move. Now, if you trade forex at 8:30 a.m., whenever there's news release, there will always be a fake move. So if you want to trade news on forex, this exact same thing will apply, right? So the moment the indices open or the news announcement, there will always be a fake move designed to take out liquidity, right? It will always be a liquidity sweep. So price instantly at 9:30 a.m. drops, takes out this low here, right? Takes out this low here. So this light blue line, or this dark blue line is the low. It takes out the low and then instantly shoots off in the opposite direction. Now this is really, really important here, so pay attention, right? So once we go below this dark blue line, right? I don't know it's a liquidity sweep, right? I have no idea whether price wants to just continue to drop massively or whether it's going to start to reverse. I have no idea, so I need to wait for confirmation. Now, there are traders who don't wait for any confirmation. They just buy as soon as price goes below an old low. That's referred to as turtle soup. So you might hear traders talk about that. That's what that really is. I don't trade that. I always wait for confirmation. And the easiest way to wait for confirmation is to wait for a fair value gap to form in the opposite direction of the liquidity sweep. So the moment this bullish fair value gap forms in the opposite direction of this sweep, right? Because remember, this is a fake move, takes out the low. So the moment this bullish fair value gap forms like this is smart money screaming at us that this really is a liquidity sweep. This is really just a fake move designed to take out stop loss orders. That's the only reason price came all the way down to this low and then instantly reverses. It didn't go down to some random point. It only came down to this low here. Okay, so now that we've got our liquidity sweep, all we need now is a simple entry. And literally any entry pattern, any indicator that you like, as long as you've got a sweep, will be high probability. So once we got the sweep, all we need is a simple entry pattern. Now you can take this fair value gap if you really want to, if you like trading fair value gaps. But for me personally, I like order blocks. I like Fibonacci retracements. And in this case, we've got a nice, beautiful order block right here, right? Because if you trade fair value gap, you're gonna have to ask yourself, which one do you take? Ideally you should be taking the lowest one, but in this case you don't even get tagged in, and it's the 1 minute chart too, right? So for me personally, I'm going to take this order block here, this nice juicy order block like this, right? So this is our order block we're going to enter on, and like I said, really does not matter as long as you've got the sweep. Really does not matter wherever you enter, but what does matter is where you put your stop loss. The only reason we wait for a liquidity sweep, this is really important, the only reason we wait for a sweep is so we have a safe place to put our stop loss. So we're going to put our stop loss always at this low here because this is the low that caused the liquidity sweep, right? Let's just zoom out right here. This is our liquidity. This move right here was a sweep. The only reason we wait for a sweep in the first place is to have a safe place to put our stop loss orders. There is no point whatsoever in putting your stop here, or here, because you're going to get wicked out, right? You're going to see price come like this and just wick out your stop loss and then go straight to take profit, right? The only reason we wait for a sweep is so we can have a high probability place of putting our stop loss orders or our stop loss order at. Right, so if you don't put your stop loss at this low here, there is absolutely no point in waiting for a sweep. You may as well just ditch it. There's no point in doing it. You have to have your stop loss at this low here, because it's very unlikely, because price has come down and taken out liquidity over here. It's going to go all the way up, come all the way back down, take out your stop loss, and then go straight to take profit, because it's already done that, right? So super unlikely that's going to happen. What is likely to happen is this, right? So you get your high probability retracement, and then for your take profit, you're going to target, for me, I'm going to target minimum 3 risk to reward ratio, right? Minimum 3 to 1. Or if you want to target, or if you want like a really good entry, target the opposing liquidity pool, right? Which would be this high right here. So if you've taken out an old low, target the old high, right? So this would be, what's this? London's high, right? So you can target London's high for an easy 4.5 risk to reward ratio like that. And if you want to learn more about liquidity, check out this video on screen now. And if you want to become a private student, check out the link in the comments down below.